Hi, everybody. Nathan Jennison here. If you're self-employed, a lot of times what happens is you hire a CPA that makes your income disappear because ultimately you don't want to pay taxes. And that makes a lot of sense. However, in terms of actually qualifying for a conventional loan, that becomes problematic because what's happening is that you can only use income that you've paid taxes on to qualify for that loan. And so oftentimes it puts you in a really bad situation where you can't qualify for enough, or what's happening is that you're going to have to claim a lot of income on your next tax return in order to qualify in that conventional loan for the house that you want. And you end up paying a lot in taxes to Uncle Sam. There's another program that we have called bank statement loans, and you can do a 12-month or 24-month. And the gist of it is that you provide statements to the lender. Those statements, the lender goes through them and basically is looking at all of your revenue deposits coming into your business. They add those up and essentially give you approximately 50% of those as your income for which to qualify for a loan. If you are running a more efficient business and you can get a letter from your CPA stating that, hey, you don't have as much overhead as is for your business as is normal, then you could get potentially up to 70% of that revenue as a qualifying income for that loan. Now, there are some downsides using a bank statement loan. This is in the private sector, so the interest rates are going to be higher. I would advise that you're probably going to be at least half a point to a point higher than what you would get on a conventional loan. The other thing is that you're going to need to have at least 10% down for your down payment. And in terms of credit, you're going to need to be at 680 or better for most lenders. And so the reality is that it's not as easy to qualify in terms of on the conventional side, in terms of credit, et cetera. And you're going to have more of a down payment than you would necessarily have to have on a conventional loan. However, when you look at the spread of interest rates between the two loans versus what you would have to pay in terms of added taxes to Uncle Sam in order to qualify, this might be a route that would save you a fair amount of money, and it's absolutely worth considering before you file those taxes. Thanks a lot. Reach out to us. We're happy to talk you through it and to look at those scenarios and how they would work out for you. In the meantime, here's the legal stuff.